For the last 2 years, artificial intelligence has completely defied gravity. It created trillions of dollars in market value, acting like a one-way ticket to unprecedented wealth. But in mid-August 2026, the music suddenly stopped.
AI was supposed to be the greatest investment story of our generation. But something strange is happening. Companies are spending hundreds of billions building AI infrastructure, Nvidia remains at the center of the boom, and yet AI stocks are suddenly under pressure. So what changed? Is AI actually slowing down, or are investors finally realizing that they may have paid too much for the future? Part 1. The August 2026 crash. Let's explain exactly what triggered this correction.
Mid-August hit Wall Street like a ton of bricks. We saw the S&P 500 drop almost 0.7% to 7,691. The tech-heavy Nasdaq sank 1.33%. But the real story wasn't just the stock prices. It was the macro environment. We had 10-year Treasury yields pushing a multi-year high near 4.72%. Add in Brent crude oil surging past $91 a barrel due to global tensions, and suddenly shifting Federal Reserve expectations, combined with those rising energy costs to completely spook the market.
So why does that matter? Think of rising 10-year Treasury yields exactly like gravity for the stock market. When the yield on a guaranteed, risk-free government bond goes up, it mathematically pulls down the present value of a technology company's future profits. If you're an investor, you're looking at this landscape and thinking, why am I risking my capital on an expensive tech stock trading at 30 times sales when I can get a nearly 5% guaranteed return? That macroeconomic gravity is actively crushing expensive AI valuations. Which brings us to Part 2, the $725 billion problem. This is where massive corporate spending collides with macroeconomics. $725 billion. Let that massive number just sink in for a second. This is the sheer, jaw-dropping scale of the financial commitment we're dealing with this year alone. In 2026, the big four hyperscalers, Amazon, Alphabet, Meta, and Microsoft, are expected to spend roughly $725 billion on AI infrastructure. Breaking that down, Amazon is leading the pack with an unbelievable $220 billion in capital expenditure. Alphabet is right behind them at $200 billion, and Meta comes in at $138 billion. Amazon actually had to hike their budget by $20 billion mid-year just because memory chips got more expensive. Guys, this is literally the largest single-year infrastructure investment cycle in the history of technology. Part 3. Big Tech's Cash Burn. Let's look at the incredible good news and the very dangerous bad news.
First up, Amazon. The top line is undeniably amazing. AWS cloud revenue surged 37% to $42.2 billion. But there is a massive red flag. Their aggressive infrastructure spending has pushed their trailing free cash flow deeply into the red, hitting a deficit of $7.6 billion. They are raking in huge amounts of cash, sure, but they're burning it on data centers and power grids even faster than it comes in.
Then we have Alphabet's balancing act. Again, stunning top-line growth. Google Cloud is up 82%, hitting almost $25 billion for the quarter, with a record $500 billion backlog. Yet, despite all that revenue, they posted a negative free cash flow of $5.9 billion. To actually fund this relentless AI build-out, Alphabet had to go to the markets and issue nearly $23 billion in new corporate debt. They are literally borrowing money to buy more servers.
And then there's Meta, the ultimate example of the industry's profit squeeze. They pulled in a massive $60.8 billion in total revenue, up 28%. But because Mark Zuckerberg is funneling nearly all incremental cash into AI infrastructure, total expenses surged by 55%. The result? Their free cash flow completely collapsed, plunging 91% down to just $784 million. They went from aggressively buying back stock to watching operating margins get totally crushed under the weight of AI development.
Part 4. The central catalyst. Nvidia's moment of truth. So who is actually collecting all this cash? Well, all roads lead to Nvidia. They supply the GPUs and the critical hardware powering these massive data centers. That makes Nvidia's upcoming August 26 earnings report the ultimate test for the entire market's momentum. If Nvidia shows even a hint of weakening demand or signals that their biggest customers are slowing down purchases, it could instantly dictate the next major move for the entire multi-trillion-dollar tech ecosystem.
Part 5. Are we in a bubble? 2026 versus the dot-com era.
This all leads to the trillion-dollar debate currently tearing Wall Street apart right now. Are we watching an AI bubble burst? Are we repeating the year 2000, or is this time genuinely different?
Let's look at this totally objectively. Critics are definitely worried. They point to the enormous infrastructure spending, circular financing, and dangerous price-to-sales valuations. But supporters argue this is absolutely not a repeat of the year 2000. Why? Because unlike the startups of the dot-com era, today's AI leaders have real revenues, massive profits, paying enterprise customers, and balance sheets that rival the GDP of small nations.
But this crucial insight completely reframes the debate. The question isn't whether AI is real. The question is whether today's stock prices already assume too much success. The technology is undeniably legitimate, but the market may have simply priced a decade of flawless execution and perfection into today's stock values.
Part 6. What happens next? Mapping the future of AI investing.
Based on the data, we're looking at 3 likely scenarios. Number 1 is a normal correction. Valuations just compress slightly back to historical norms, and the bull run resumes as AI starts paying off. Number 2 is a long consolidation. AI stocks might just trade sideways for a few years while corporate earnings slowly catch up to these elevated prices. Or, number 3, a deeper AI investment reset. If interest rates stay high and companies can't monetize AI fast enough, we could see a painful structural repricing of the entire tech sector.
To navigate these scenarios, here is exactly what you need to watch next. Keep a close eye on AI revenue growth versus capital spending. Are they actually turning a profit on the billions they deploy? Watch that free cash flow resiliency. Monitor Nvidia's GPU demand like a hawk. Keep checking those 10-year Treasury yields because, like we said, that's the market's gravity. And finally, track valuations and how quickly these AI applications are actually being monetized by everyday businesses.
The AI revolution may not be ending, but the era when simply saying AI was enough to make a stock rise may be ending. The easy money driven by hype has likely been made. From here on out, it's all about real cash, real profits, and real execution. Thanks for joining me for this explainer. Please note this educational analysis does not constitute personalized financial advice. Always do your own research. Keep watching those metrics, and I'll see you next time.